It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're checking up on the best way to play the shifting healthcare landscape, particularly when it comes to the retail side. I'm here with Alex Morris, FM Investments President and Chief Investment Officer. Good to see you. Thanks for coming in.
Thanks for having me, Joe.
So let's get to your buy on this side of the equation, and that is CVS Health that we were talking about here. Here's the stock over the past year. It's kind of trended a little bit down, but let's look at some of the catalysts that you say can help it from here. Experienced leadership, first of all. Talk me through that one.
So leadership team has been intact for a long time, which in a changing marketplace isn't always true. And this leadership team in particular has shown the ability to grow the business and to grow it on like metrics and to keep what is a pretty competitive space very competitive for them. So I like the way they've positioned themselves and their consistency.
What's interesting too about CVS is obviously it's not just a pharmacy chain. They now have a much bigger business and that vertically integrated business model where they offer insurance as well.
Right. Their merger with Aetna took them out of just the shop that you see on every street corner, which is good for the first part of their business. But now they're vertically integrated across all parts of what you need in keeping yourself healthy. So when you're going to go to buy something like a prescription, you're going to buy other items from the store as well. And that's something their competitors just don't have. Now, that also has with it all of the headaches that come with being an insurance company, but some of those are some pretty attractive financial metrics that we really like that will hold them through what might be difficult retail times in the coming weeks and months.
Let's talk about the financial metrics now, because you are looking at things like free cash flow and earnings growth. If we take the latter of those and look at earnings growth, there it is. Here's the earnings per share growth that we've seen over the past few years and the estimate for this year.
We like the trend line. I mean, everyone would expect this to be for every stock. It's not. Not every stock can be an AI chip stock, but we like the growth rate and we like the fact that they're also using their free cash flow well. So growth rate is going up and they also beat estimates, which I think is underestimated. Really like a company that not only is growing, but that can reliably beat the street. And when that happens, stock prices tend to follow. They tend to follow with a little extra pop. So you get the good underlying company and then we'll benefit for that underlying momentum translate in higher prices.
We also like to talk about not just what the bull case is, but what could go wrong. And you sort of alluded to it when you said there are advantages to having this integrated model, but then there are some risks. And one of the risks is a medical loss ratio, which is basically a metric that you look at in the insurance business. How much of your premiums are you paying out to take care of patients?
Yeah, the biggest problem is they're also an insurance company. So folks have put off getting some health care during the pandemic. Some of that has trickled through to today. More folks can come back. Plus, it's healthcare. There's a lot of things that can go wrong in running an insurance company. They do it well, and we like their ability to monetize elements of that value chain, but they're still running an insurance company. And when things go wrong in the insurance company, you can have an unlimited amount of money needed to take care of your health. You don't have an unlimited amount of money for Skittles. So we see that as a risk, but so far they've managed it very well.
And just to be clear here, do you guys have CVS in your portfolio?
So we do have CVS in portfolios.
Okay, gotcha. So that's the good buy. Let's get to the good buy, the one that you do not like as much in this space. And that is Walgreens Boots Alliance here. And there, the stock has been a worse performer over the past year. Here, too, is sort of the inverse of the other, right? We're starting with high leadership turnover.
They just can't seem to keep a lot of folks in the top chairs. And you see that across strategy, and they haven't had a really coherent strategy. And you see that across just all the business units they're trying to operate, where when you don't have that sort of coherent leadership, you don't get a single message. You see that translating in the stock price, you see that translating in earnings. And we're going to see that in some other charts where they just can't seem to make good investments reliably. And that's a problem when we want stocks to go up over time based on good investing.
Right. And then the other sort of inverse is that it's just a pharmacy chain, right? They don't have insurance in some of the other businesses.
They have no offset to what has become a very big shoplifting problem. I mean, you walk into most Boots, most Walgreens, most CVS to that extent as well, but shoplifting has become a big issue. Some stores are closing, particularly in high traffic areas where municipalities haven't been able to combat that. And without an offset to that, without a reason to bring people into your brand store, it's hard to really justify keeping some of those stores around. And when that's your only revenue driver, that's a problem.
Yeah, interesting. And then finally, if you look at what's going on with their free cash flow and earnings, you've got sort of not as clear a picture.
Yeah, it's a mixed message here. And if we looked at this on a free cash flow basis, we would see that CVS is growing at about 17% a year. Walgreens Boots is contracting at about 50% on a 5-year basis. And that's just going the wrong direction. So although they trade a little cheaper, they have a greater dividend yield than CVS, they don't seem to make good investments with their own capital. And for the short run, that might be nice for short-term dividends. It's not great for the long-term outlook because eventually they'll run out of money.
Right. And then if there's something that could go wrong for your bear thesis in this one, it's perhaps the new CEO of the company, Tim Wentworth. There is some optimism that is surrounding his appointment that he might turn things around for the company.
He's an industry veteran. He's done these things before. I think he will be successful in the long run. The risk to our thesis is he successful faster than we might expect? And if he is, then it's great news for WBA holders. But it's going to be a big ship. There's a lot of moving parts. They've got a much more pronounced international business, which always is harder. That brings a dollar risk to it as well. So they've got a lot of moving parts. He's got a tough job ahead of him.
And when you talk about positioning in Walgreens Boots, are you short the stock or you're just not invested?
We're just not in the
here?
stock. We're not short it. I mean, as you saw, the charts look similar. Walgreens Boots just a little worse.
Right.
But we don't think it's a terrible stock. Certainly, it's a profitable business still.
And when you're talking about CVS, you're looking at sort of a longer term play when it comes to that company?
It's a longer term buy. As you saw the chart, it's a nice, easy curve up into the right, which is what we want to see. Most of these names, health insurance names, don't get a lot of short-term action. This isn't a day trading stock. This is a long-term hold stock.
Gotcha. All right. Well, let's sum it all up, shall we? You're telling investors buy CVS. The leadership team drives success. It's experiencing growth in its business. On the other side, you say avoid Walgreens as it endures high leadership turnover. It's also experiencing a contraction in its business. Alex Morris, thanks so much.
Thank you.
Good to see you. Thanks for coming in. And that'll do it for the latest installment of Goodbye or Goodbye.